Hello, Trade Pro. This is Victoria from Trade Pro Academy, and today we are going to be wrapping up our free day trading course here with Lesson 6, the trading plan. So far we've gone through the basics into futures, technical analysis, market structure, order flow, and even presenting a day trading strategy for you. Now, if you guys enjoyed what you saw and you've signed up for this free day trading course to be recorded live, we have an offer for you at the end of today's lesson. This is going to be a one-time thing, not available for the recording. So stick around and we will present that to you. Now, if you guys want to know more about order flow, we have this great free order flow trading course. Check it out, the links down below. But having said that, let's start off with the last lesson of this free day trading course. And today we're going to be talking all about the trading plan. Now, the trading plan is maybe the most important thing you'll have in trading, and it is there to really hone your discipline and get you to that level of consistency. So, let's talk about what we're going to be looking at today. The trading plan, of course. What is a trading plan? How to build a trading plan, the risk management importance, building a risk management plan, and let's just jump into it. So this is the most important tool you'll have, guys. We explained this before, and I can't stress it enough. So this is the number one factor you do need to day trade. You have to have a plan and you have to follow that plan. Now, the plan encompasses a whole variety of different things: your fees, paying yourself, etc., your personal rules, risk management, and the strategy you trade. Now, this right here is super important, guys. The actual strategy and following the rules, the set of rules that come together with this strategy will help you in the long run. This is what this plan is all about. So if you have a plan and you follow that plan, that's how you gauge the level of consistency and profitability in day trading. Now, at the beginning of the journey, it may look something like this in terms of your profitability and your journey, this being time, this being profitability right here. And you might be struggling, not knowing what you're doing wrong. Sometimes you do well, sometimes you don't. And it's just a random sequence of events, random trades. Now, if you have a plan, personally, I found a pretty interesting difference, and my progress actually started something like this, maybe some dips here. But for the most part, we have an increasing slope. Now, the plan is to build the consistency, right? And in order to do that, you have to test a strategy and a system. You have to follow your risk management and your personal rules. So let's go ahead and dive into that a little more. How to build your trading plan. So there are a few important things here in terms of building your trading plan. You have to have a mission statement at this point. A mission statement being, what is this plan? Why are you building this plan? And what will this plan serve, right? It's just like any business. Trading becomes a personal business. So, in terms of day trading, you have to treat it as a business. As you go in every morning, you fight for that profitability, and you do that with a high degree of certainty by executing your plan. Have a plan, trade the plan. That's what we say in the room all the time. That's what we live by, and that's what we go by every day. So you also have to have a process and routines. So like any business, what is your process? What are the routines? So routines could be maybe looking at markets in the morning, identifying different levels, identifying your key levels, your next best trade levels, as we talked about. So it's a key importance of the plan, having the next best trade, and your processes. So what kind of process do you take in terms of actually executing the trade? What do you look for? How do you do it? And again, going back to the routines, trading that plan. You also have to understand what the cost of doing business is. This is important, whether you're measuring based on commission, some of the fees that you pay, brokerage fees, whatever, maybe platform fees. You have to understand how much you are paying to be in this business. And then capital and risk management. How much capital are you starting out with? And this is dependent on your risk management plan that we're going to talk about today. How much capital are you risking per trade, and how much are you looking to make per trade based on that risk? And then you're going to have a trading strategy. So that system, we identified one of the trading strategies that I use on a daily basis that I love. So have a trading strategy, test it, identify it, find its consistency. If your trading strategy works 60% of the time and you're managing risk, you are going to be a profitable trader. Now you're going to have some rules and consequences. These rules are the rules at which you select trades, place trades, and then consequences for hitting daily drawdowns, weekly drawdowns, whatever it may be. You have to be the boss and you have to stop yourself at a certain point. If the mental capacity isn't there and you're still looking to come back from a larger loss, guess what's going to happen? That loss is going to accumulate. So you have to have consequences for yourself. And in this business, this day trading business, you have to be both the boss and the employee, right? So you have to take out the boss hat when it's dire, but otherwise you're the employee working for yourself. And then journaling, how to build this plan. You need to journal because this identifies your mistakes and how you make them better and where you can go from there, right? So, whoa, whoa, okay. So when you are journaling, this identifies what kind of trades you took. Were they good trades? Were they bad trades? And were they to plan? Were these trades to your plan? If they are not to your plan, why did you not take them to plan? And if they are to your plan, was it a good trade? Was it a good idea? Was it a good risk management trade? If it's a trade to your plan, it's worth reviewing at that point and see where you may have made a mistake, or maybe sometimes you do trade the plan and sometimes the trades don't work, and that happens. No plan is going to work 100% of the time, but as long as you're implementing the plan 80% of the time, you'll see consistency and growth and progress. So, have a plan, trade the plan. A lot of people get into trading without a plan. They go in there sporadically, willy nilly clicking buttons, and that just does not work. You have to have a set of rules that get you in and out of trades, and you have to follow them diligently. So backtest them, backtest those strategies and rules, and find the consistency to them. Like I said, no one sticks to the plan 100% of the time. It's just a fact. We're all human. We're all prone to emotion and psychology. Emotion drives the market, so we're obviously going to be prone to it. Now, not everyone manages to stick to that plan 100% of the time, but if you can stick to it even 70 to 80% of the time, and you find a plan that actually shows promise and consistency and progress, then you are a winner. You will find the consistency in the market that you are looking for. Now, in terms of the strategy, we went through this last time. If you guys want to check that video out, go ahead. I'm not going to jump into it too much here, though. Um, but what I mainly do is when I trade futures, especially the ES market, remember, day trading at TradePro Academy, we use the futures. So I mainly trade the ES, the S&P 500 futures, and I do my strategy based on the 10 tick and the 4 tick range charts. So this week, that 10 tick got bumped to a 20 tick because we've had a lot of movement, the 4 tick into a 10 tick. So much movement that we could bump up the tick size, bump up the stops, and bump up the profit. Now, we have to change as the market changes in volatility. Now we go from larger time frame to smaller time frame, multi-time frame analysis, even though these aren't time frames, these are tick ranges. So we look at the macro, then to the micro, identifying the structure, looking for the next best trade. Am I taking a break of a top, retest that top, or am I taking a break of a bottom, retest that bottom, right? What is my next best trade? And I execute based on what happens. Now I wait for the rotations to confirm that those levels are sticking. So remember last time we talked about the pullback strategy. It's in full depth in our last YouTube video, in our last live day trading video that we have here. Um, so we wait for that confirmation and we wait for those rotations to actually confirm that. Now, we wait for the footprint to confirm as well in terms of order flow. So when we explained order flow, that becomes one of our confirmations. We are looking for buyers to come in at support structure or sellers to come in at resistance structure, and we identify our trade entry based on our stop loss. That is such a key factor that I learned not recently, but that I learned that really shift my trading. Why am I getting stopped out all the time? Well, because my stop is in a place that gets stop hunted easily. If I place my stop above stop hunt areas and I place my entry based on that, yeah, I'm not going to get filled 100% of the time probably, but I get filled just enough to find that high probability entry area. Now, I'll go to level 2 inventory and identify what is on the DOM and if my trade idea has interest to the upside or the downside and base off that. Then I execute and the trade does not end there because I manage the trade and I look for scratches. If it starts going against me, if I start disqualifying the trade, I'll take it for a small loss or a small profit. Now, let me just
Happy Valentine's
see
Day.
something here. In terms of risk management, so we have to talk about risk management. This is one of the most vital portions of trading. So it really depends on a lot of people what their risk management plans are, how much they risk per trade, how much they risk of their account, whatever it is. However, when it comes to day trading and futures, it's super highly leveraged. So we don't really have to risk too much per trade for our account to use a small account. That's just the fact. And By doing so, we could really take control of the leverage that the futures market actually has to offer and really make a substantial potential profit from that, right? So, in terms of a risk management, what I like to do is risk maybe 1 to 2% of the account. And on the ES, if I'm using strictly the ES here as an example, it's about if I use a 5 tick stop, right? It depends. Sometimes people use a 7 tick stop to a 10 tick stop, but personally, I'll go a 4 to 5 tick stop, which may be a little tight for people. But depending on this, based on the 5 tick stop that I'm showing you guys here, $12.50 a tick on the ES, that means that if I'm risking that much per trade and I'm risking 2% of my account balance, that means that my account should be at $3,125 to trade a one lot. That does sound like a little more than anticipated, but if that's the risk management plan that I'm willing to go by, risking just 2% of my account per trade. That's the amount of money that I should need in my account to actually trade a one lot. Now, in terms of the maximum daily drawdown, that's mainly up to you how much you're willing to risk in your account, but you have to keep in mind the maximum daily drawdown versus the maximum, well, not maximum, but your daily profit target. And the daily profit target should outweigh the maximum daily drawdown. Recommended, I look for five. I honestly risk about 5 to 6% of my account on a daily basis, which may seem like a lot, but again, finding the consistency in the trading plan allows me to do so. Now, not a lot of people might be comfortable with that, but again, it's mainly up to you. But you have to follow your rules. If you hit your daily max drawdown, then you have to either stop trading, analyze your trades, review your trades, and think to yourself, is there really a potential of me coming back from this? Am I in the right mental state? Do I have mental capital for this right now? So if you're risking 65.50, so 5 ticks, a full stop on the ES or less, depending on your scratches, your brackets, even maybe more, for $100, right? Each trade would be a $100 gain on a one lot. Each trade is 3.2% gain in your account. So what I'm doing is outweighing the gain potential versus my stop potential. Now, you always want to aim for more than you risk. It doesn't make any sense if you're risking a lot more and you're making these little incremental gains. That's not consistent and that doesn't allow longevity in your trading career and your account. Now, on a daily basis, if I'm risking 5 to 6%, right? And that's about, let's say, 150 bucks on this account, I should be making 7 to 8, 7 to 9, 10% even. So on this account, 10% is just over $300, and that's three positive trades on a one lot, right? Which may not seem like a lot, but it can be difficult, and it doesn't have to be if you're in that right state of mind and have that psychology up to par. Now, if I drop it down to the micro, risk management for the micro, because equity futures have micro contracts as well, which are a tenth of the size of the minis, which enable a lot of people to get into the futures market a lot more comfortably with less capital. Now, this is great for a lot of new traders that are coming out and trying futures trading or want to get into it. It really opens the door for high leverage in a small account. So again, if you're risking 1 to 2% on the MES or the micro, you're only risking 6.25 bucks or $7.50, depending on the stop, right? If you're risking 2%, that only requires $312 in your account to trade a one lot, right? And the MES, the beauty of it is you can learn how to scale 2 to 3 lots very easily with little capital, right? You'd only need about what, 625 bucks to trade a two lot on this if you're using these risk management rules, or if you're using a wider stop, 2%, you only need $375 for a one lot, two lot. What is that? About 750 for a two lot, right? So you need a very low amount of capital to actually trade these positions. And of course, you're risking a lot less, but the return could be pretty decent, especially if you're catching longer moves like you have seen in the past few days, in this past week. Now, again, same rules apply if you're risking 5 to 6%. You're looking for a significant gain of even upwards of 10% on your account. Again, 30 bucks if you're looking for just what is that, like 6 to 7 points on the micros. That's very possible in market conditions like today. So if you're risking $6.25, right, you're looking to gain about 10 to 12 bucks on each trade, right? Always aim for more than you risk. Now, Another portion of the plan in terms of risk management day trading is you have to be your own boss, right? This is a business and you are the boss. You have to set your rules and follow them. That's what it's all about. This market requires disciplinary action and disciplinary rules for you to actually find that consistency and be honest with yourself. Now, it means you have to limit yourself to a certain amount of trades a day, right? So I personally limit myself to 4 to 5 trades a day maximum on the higher end. That might not seem like a lot, but again, if you're trading 2 to 3 lots on the ES and you're getting partial or full take profits, it only takes 2 to 3 trades to make your daily profit, right? It doesn't take that much, and it doesn't have to be super stressful. You don't have to be in the markets all the time to hit that $500 a day or $1,000 a day, whatever it may be, right? It does not take a lot. You just have to be disciplined in your rules. I also recommend timing in between trades, meaning if you get in a trade, even if it hits your profit target right away, I suggest not looking for the next trade right away, right after that trade is over. Give it some time, do your analysis, look for that next best trade yet again because that's how you qualify that winner, especially if you get a losing trade. Don't look to revenge trade and jump back in the market to make those points back. Set some time in between those trades, look for the next best trade, especially on losers, analyze that loser, and identify an amazing trade opportunity that's high probability. The time between trades is super important, and the boss has to come out and really differentiate between that employee and say, okay, now we need to look for something better. We need to get back on the horse here, and this is how it's going to be done. Analyze your trades in real time, so after the fact of the trade, like I just said, and not letting your trades turn into hope. This is huge. So you have to let the boss, the risk manager, come out as soon as you feel the hope arriving in your trade. So if you're in a trade and it's diddling close to your stop loss and you're like, oh, please, 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 I think it's going to go up. I think it's going to go up. When all the qualifiers are telling you it's going to go down, once you start hoping, that trade is over, and you have to really understand that. That's a very pivotal portion in the psychology and the risk management portion. So that is all I had for you guys today in terms of our futures day trading course. So this is a free course. I hope everyone really enjoyed it. And now for this special offer. So what we have for you guys today is actually a discounted offer. A discounted price is available for only people who've seen it live. Now, this is your chance